So you welcome to CN Professional Institute. So in this session, we'll be looking at property, plant, and equipment. We have so many questions I'll be solving today. They are here. We'll be looking at these questions here. Question one is on how to determine the cost of PPE. Then we'll look at question 2, 3 is on revaluation. 4 is on transfers. There are these transfer provisions in IAS 16 where we transfer a portion from the revaluation surplus account to retained earnings to make up for the reduction in profit as a result of revaluation gain. We'll look at all those things here. So we'll look at that in question 4. Question 5 is also on the same transfer together with revaluations, right? Question 7 is on determination of cost of PPE, where we have abnormal wastage, where we have abnormal wastage. So we'll look at question 7 as well. Then question 9, the same. Question 10, 11, and then finally look at question 13. Yes, question 13 here is a bit complex, right? It's a bit complex with so many notes. 14, the same thing here, right? Then 15 to, so we have 15 questions here that we'll be looking at, right? So stick and stay, we'll solve all these questions, right? But before we start this question, let's go back and see what we have in the slide. So let's look at the initial recognition of PPE. Let's look at the subsequent measurement. We'll look at revaluations, and then we'll come back and solve these questions, right? So let's start. Okay. So let's start here. What are PPE, or what is PPE? Or let me say, what are property, plant, and equipment, right? So we say property, plant, and equipment are tangible resources, right, that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. So that's the definition of PPE. PPE, they are owner occupied, meaning the entity use the PPE for what? Production of goods and services, or for rentals. I'll talk about that. You might think, okay, when we talk about for rentals, then you are going to leases or maybe investment property. So I'll brief you on that so that you know that even though sometimes you can rent out PPE, okay, to others, it still qualified for what? It's still qualified to be called PPE. You can rent your land, or let me say your building, to others, but it's still qualified to be PPE. All right, especially when it is within a group. So if you are looking at a group, okay, where we have parent and subsidiary, if one party in the group leads to the other, okay, from the perspective of the group, it is still PPE because we see members in the group as one. So the parent and the subsidiary are seen as one. And therefore, if there's any rentals or if there's any transfer of PPE between them, we still see that as PPE, not investment property or not leases, right? So which are reading the standard, and you see that we call properties, okay, rented to others, we still refer to them as PPE, and that's the reason. This is normally for what? Group account. Okay, don't worry, we will look at consolidation as well. So just know that PPEs are resources, or they are assets, they are tangible assets that are held for production of goods and supply by the entity itself, for rental to others, or for administrative purposes. So the entity has building that they are using for the administrative purposes, for their day-to-day running of the business, is PPE. If they use it for production of goods and services, so PPE. All right. So don't forget that PPE is also called owner occupied. Owner occupied, right? So PPEs are mainly used for production of goods and services, or for administrative purposes, or for rental to others, and they are expected to last for more than one financial year, and that's what makes them what? Non-current assets. So PPEs are non-current assets. They are non-current assets. Why are they non-current assets? Because they are expected to be used more than what? One financial year. Okay. And the definition of an asset is there. An asset is a resource controlled by an entity as a result of past transactions and from which future economic benefits are expected to flow to the entity. So that's the definition of PPE, right? Now, we recognize PPE only and when only, okay, these two conditions are met. One, it is probable that future economic benefits associated with the PPE will flow to the entity. Don't forget, this is in the conceptual framework. So we record PPE, okay, in our books when it is probable that future economic benefits associated with that PPE will flow to the entity and the cost can be measured reliably. So don't forget, when it is probable that future economic, okay, benefits associated with the PPE will flow to the entity, and then two, the cost can be measured what? Reliably. Cost can be measured reliably. So we can estimate the cost. Okay, we can put a reasonable figure or a reasonable amount. We can attach a reasonable amount to the PPE as the cost. So these are the recognition criteria, and these two conditions must be met for us to recognize PPE in our books. Future economic benefit associated with the entity should flow to future economic benefit associated with the PPE should flow to the entity. Then the cost should be measured reliably. So we expect to get some benefits when we use the PPE. It's expected to bring some inflows to us. Okay. Other than that, we can't say it's PPE. All right. So we expect to get some benefits as we use it. All right. Okay. Then let's look at the initial measurement of PPE. All PPEs are initially measured at cost. Don't forget. And subsequently, we can use the cost model or the revaluation model. But initially, it's at cost. Don't forget. So PPEs are initially measured at cost. And subsequently, you can choose the cost model or the revaluation model. So we'll look at these things in details as we move on, right? We just know that PPs are initially measured at cost and subsequently at either the cost model or the revaluation model. Now that we know PPs are initially measured at cost, right? What entails cost? So when we say cost of PP, what do we mean? What do we include in the computation of cost and what do we not include? So pay attention. We are going to go through all the items that will be included in the computation of cost of PPE, and we will also look at items that will not be included in the computation of cost of PPE, so that when you see a question and you are asked to determine the cost of PPE, you know items to include and items to exclude. All right. So it says the cost we talked about right now comprises all costs directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in a manner intended by the business. So we are looking at the cost as all directly attributable what cost, okay, incurred in bringing the asset to its current location and condition. So we are going to look at all directly attributable cost that is incurred in bringing the asset to its current location or condition. So this is what entails the cost of PPE. And don't forget, PPEs are either purchased or manufactured. They are either purchased. Let me change my pen color so I can write it. You see, PPEs are either purchased or manufactured. So the entity can construct its own building and use it for the administrative purposes or for supply of goods and services. They can do it. So PPEs are either manufactured or purchased. That's one thing we have to know. When it is purchased, we have the way of determining cost. When it's manufactured, we have way of determining what cost. Basically, when it is purchased, then we look at all attributable or directly attributable costs incurred to purchase the PPE. When it's manufactured, then we have to look at the manufacturing account. So what goes into the cost of production, where we bring all our direct expenses, direct labor, direct material, and other direct expenses. We get our prime cost. Then we add factory overheads or production overheads, and we get the cost of what? Production. So take note, PPs are either purchased or manufactured. Now, let's look at the cost of PPE. So let's look at the cost of PPE when purchased, and then we look at the cost of PPE when what manufactured. Okay, but basically IS 16 is more like PPE being purchased. But we'll look at both. All right. Now, if the PPE is purchased, then these are the items that we factor in or we take into account when we are determining the initial cost or the cost of the PPE. One, we bring the purchase price net of what trade discount. So you go to the shop or wherever you want to buy your PPE, you go there and you are told that, let me see, this motor vehicle is you are told this motor vehicle is let's say 50 million. Okay, but they give you a trade discount of, let's say 100 million. I'm just assuming they said they give you a trade discount of 100 million. So you have to what take away the trade discount, the 100 million, and then you have 400 million left. So the 400 million left is the purchase price net trade discount. So don't forget, trade discounts are deducted if the purchase price includes what trade discount. So if the purchase price includes trade discount, then you have to take it away, because trade discounts are not recorded. Basically in accounting, we don't record trade discounts in our books. It's a cash discount that we record. So if the purchase price is inclusive of trade discount, you have to get a trade discount and take it away. Then, so we know we have to add the purchase price net of trade discount, then import duties and taxes. So import duties are also added. So let's say you purchase the PP from the United States. Okay, you imported it. All duties that you pay at the port, they are added to the cost of the PP. They are capitalized. So all your import duties, do that you pay at what? The port. Okay, import duties and taxes are what? They are added. So don't forget, we include import duties. So when you see a question and you see import duties, we include it. And what? Taxes are also added. But you have to take note of that. The taxes are in two forms. We have refundable taxes and non-refundable taxes. The refundable taxes are not included. It is the non-refundable that we include. I'm saying it again. I'm saying the taxes are in two forms. We have the refundable taxes and then the non-refundable taxes. Okay, the non-refundable ones are added. So let me write it. I will explain further. So non-refundable, also called non-reclaimable. We add it to the cost of the PPE. So the non-refundable taxes are added, or the non-reclaimable ones are added. But the refundable ones, let me write it here. Refundable or reclaimable, they are not added. So you exclude them. Please, let's not forget. We will solve plenty questions where you see they tell you refundable taxes and non-refundable. Now, what do you mean by refundable taxes? Refundable ones are those that when you pay them, you are reimbursed by the revenue authority. All right. So in Ghana here, we have the Ghana Revenue Authority. When you pay those taxes, you are refunded. The example is the VAT, the value added tax. Okay. When you pay taxes like your import VAT, your input VAT, the one that you pay on purchases. When you buy, you pay input, and then when you sell, you have your output. You see, you offset the input against the output, and you get a refund from Ghana Revenue Authority. All right, or you're allowed to deduct your input VAT. So VAT or value added taxes, one of the refundable taxes. Okay, and those ones are not added. They are not added. They are not. So please take note of that. The refundable ones, those that you can claim them back, are not added. So the refundable ones are not added, but the non-refundable, those that when you pay them, you will not get any reimbursement. They are added. So be very, very careful. We'll solve questions like that. Then cost of site preparation, where you purchase, let's say, your equipment, you want to install it. So you have to get somebody to clear the land, do everything. All those ones are um they are added, cost of site preparation. Then delivery and handling is more like carrying inwards. So you purchase the PP, the motor vehicle or the land. And let me say no land, we can't transport land. Let's say the okay, you purchase an equipment from somewhere else, maybe in Accra, from Lagos, from wherever location you are, you purchase it, and then therefore you have to transport it to the current location. It's like transport cost, delivery and handling, those that will carry it from year to year, come and put it down. They are costs. So delivery and handling cost is also added to the initial cost of what the PPE. Then installation and what assembling cost. You have to get engineers to come and install it, fix this, fix that, because before, let's say, the plant can start working. So all installation and assembling cost. Maybe when you purchase it, it was in parts, different parts. So you have to get engineers to assemble them. It's what um it's also added. Okay. Then you see wages and salaries and other employee benefits relating to the acquisition, construction, and installation. So wages and salaries, and this more like when you are manufacturing a PPE, instead of what by constructing your own building. Let me say constructor. Okay. So you're constructing your own building. So you pay workers, you pay them wages, salaries, whatever to work for you. Those ones are all what included. And there's the wages of the installers, those that will be doing the installation. It's all added. All right. Then we have cost of testing whether the asset is properly working. So when you are done, you want to test if the asset is properly working, the PP is properly working, right? Any cost you incur to test whether the asset is working or is functioning is also added. Then professional fees like lawyers, architects. Sometimes you need lawyers' advice, or you need let's say sometimes broker fees. Okay. Sometimes you might need broker fees that you pay to brokers, maybe lawyers, consultants. You ask for their opinion. All these costs are what are added to the cost of what PP, right? Okay. So that's also there. So that's the professional fees. Okay. Then you have decommissioning cost, and decommissioning cost is covered by IAS 37. Okay. Provisions, contingent assets, and contingent liabilities. Provisions, contingent assets, and contingent liabilities says IAS 37. So and IAS 37, there's something called the decommissioning cost, okay, or restoration cost, where you are taking up a project right now, but in the future you'll be required by law, or if it is not by the law, you'll be required to what restore the site. Let's say these oil companies, okay, what they do is that they before they start the extraction of the oil, they mount or they set up these oil rigs and stuff. They mount them. At the end of the life, when they're done with the extraction, they are required to remove the rigs and all assets installed. They are required to remove them and restore the site. So the standard is saying any other cost incurred or all costs that will be incurred to do this restoration or this decommissioning, okay, discount it to present value and add it to the cost of the PPE. It's there. It's also in IAS 7, which we'll be looking at. All right. So that's the decommissioning cost. So decommissioning cost is part, and I said it is future cost and it is discounted to present value. We'll look at it shortly. Right. So these costs are added to the cost of what? PPE. All right. Then on the cost of PPE, we have some costs. So this is what I talked about. So they said the purchase price after what? Any trade discount and rebates. So rebates are also deducted. All right. Rebates are more like refunds. Okay, maybe you sell to somebody and the person brought back some of the goods to you. Okay. So you have to less it. So rebates are also less. If the purchase price is inclusive of the rebate, you less. And they said plus any import duties, we look at the import duties and non-refundable sales taxes. I told you that non-refundable taxes are added, but the refundable ones are not added. It's the non-refundable that we add. Then this is when the entity has an obligation to dismantle. This is what I talked about, the decommissioning cost, okay, or the restoration cost. So when the entity has an obligation to dismantle and remove the asset at the end of its life, then the initial cost of the PPE should include an estimate of the dismantling and removing the cost of dismantling and removing the asset and restoring the site where it's located. So I said 7. So I told you, if you be required to dismantle whatever asset you are setting up or whatever you are installing, if you be required to remove it or dismantle it in the future, discount it to present value and add it to the cost of the PPE. Then when you are done, you unwound. There's something called the finance cost. Okay, so the finance cost is charged on the present value. So when you discount the present value, then you calculate the finance cost on it. Okay, and then you record the finance cost in P&L, and then the present value of the dismantling cost will be a liability. All right, so we'll solve questions on this stuff here. Then we are still looking at things that are added to the cost of PPE, and all these things are part. Then there's something we call the borrowing cost, IAS 23. So IAS 23 is saying an asset that takes a substantial period of time to make them ready for use are called qualifying assets. And the standard further says that borrowing costs incurred on qualifying assets are capitalized. So let's say the borrowing cost is a separate standard. Okay, a separate standard. So I'll have videos on borrowing cost. But let me brief you on the borrowing cost here. Okay, so borrowing cost is just the cost you incur if you are borrowing funds, which includes interest on loans. Okay, and stuff. We'll look at separate standards. The separate standards, so we'll look at it. So the standard is saying if the borrowing cost is for a qualifying asset, then you have to capitalize it. You have to add it to the cost of the asset. So let's say you went for a loan of 20 million and the bank charge you interest of 1 million. So the 1 million interest is the borrowing cost. So the standard is saying if the asset that you'll be using this loan to finance is a qualifying asset, meaning it's an asset that takes a substantial period of time. It takes a substantial period of time to make it ready for use or for sale. Then you have to add the borrowing cost to it. So let's say you went for this loan to come and build your house, to come and construct PPE, to come and construct a building. Building is a qualifying asset. Not all buildings are qualifying assets. If you are constructing the building yourself, it's a qualifying asset. But when you are buying it, it's not a qualifying asset. Why? If you buy it, you need to buy it ready for use, so it's not a qualifying asset. But if you are constructing, then it's likely that it take some time, and therefore it becomes a qualifying asset. So then you have to capitalize the borrowing cost, right? So that is borrowing cost. So watch out. If the qualifying asset, then you add. Then the last thing is, so watch out if you have interest on loans. Okay, the question is, before you decide on whether to capitalize or not, you have to first check if the assets are qualifying assets. If it takes some time, like maybe a year or 6 months going to make them ready for use before you add. If not, you won't. So as I said, we'll look at this. It's a separate standard, IAS 23. We'll look at it and then we'll delve more into borrowing costs so that you know how to treat it. Then the last one is saying if the PP is acquired on credit and payment term exceed a year, there's a financing element, and therefore we need to discount it to present value. So this is what we mean. Let's say you purchase a building for 20 million, but this 20 million will be paid in 2 years' time. Okay. If you add the whole 20 million here to PPE as the cost, then you are wrong. Because whenever we are looking at a duration of a year or more, then we say there's a financing element, and therefore we have to discount the figure to present value. All right. Okay, so whenever we are looking at um, a duration of a year or more, there's a financing element, and therefore we have to discount the present value. So you can't record this 20 million as the cost of the PP. You are wrong. It should be discounted to present value using 1 over 1 plus this n by the discount factor. You are going to have 1 over 1 plus maybe you get the discount factor, let's say 0.1 raised to the power something like 2. All right, you have to discount it. So let's assume after discounting the 20 million, I'm just assuming, let's assume we get something like 5 million, or let me say 50 million. Then now the 50 million is what we are going to record as the cost of the PPE, not the 20 million. Please. The difference between the 20 million and the 50 million is the financing element, which is recorded in P&L. Okay, so you don't record it in a year, you spread it over the 2 years. So have this in mind. This is also one principle you can be tested on. Whenever you buy PPE and the period is more than you, and you buy it on credit, okay, you buy it on credit, you are not paying immediately. The period is either 1 year or more. There's a financing element. So you can't record the whole amount as PP or as the cost. You have to discount it to present value. And the present value is what you are going to record as the PP. The difference between the present value and then the future value. Or the difference between the present value and then the amount you're supposed to pay in the future is the financing element, and record it in the profit or loss account. So this is also a principle. Okay. Interest on deferred settlement is recorded in P&L. It is not capitalized. In this case, the difference between the 20 million and then the present value 15 million. That 5 million is called interest on deferred settlement. And interest on deferred settlement is recorded in what? Profit or loss. It's not capitalized. Profit or loss as an expense. And it's not added to the cost of the PP. So watch out. You see a question where they said um, there's interest on deferred settlement, meaning you didn't pay early. I mean, you didn't pay promptly. You purchased on credit, and therefore they charge you some elements. Okay, for deferred settlement, it's recorded in P&L. So don't forget that whenever you acquire your PP and you are paying on credit, if the period is a year or more, please discount it to present value. Okay. Then these are the costs that we don't recognize. These are costs not recognized in the cost of what? PPA. All right. So we are done with the costs that we are going to recognize in the cost of PPE. We looked at them here. So we looked at it here in detail. I'm sure you get to understand them, or you've understood them. Let's look at cost not to recognize. Then maybe we can start solving some questions. So let's look at cost not recognized as part of what? The cost of PPE. So one is operational reorganization cost, which is like expense related to restructuring or reorganization. Um, and this can't be included in the cost of what? The asset. Okay. They are not recognized as part of the cost of the PP. So don't forget restructuring cost. Maybe the entity wants to restructure their organization operations. They want to do reshuffle. Okay, they want to lay off some workers, change the organizational structure, um, transfer some assets from one department to the other. Any organizational reorganizational cost is not. Then cost of opening a new facility is also not. Right. So the cost of opening a new facility, we said there are expenses incurred, okay, just for starting up a new location or starting up a new facility. So example could be, let's say, staff training or marketing cost. So staff training, marketing, all these are not added. Okay. Then cost of introducing a new product is also not added. Okay. So these costs are more related to what in the new business and not directly linked to the purchase of the asset. So we don't. Um, Administration and other general overheads, administrative expenses like manager salary, sometimes depreciation, wages of other people, like all these ones are not added to the cost of the PP. So general administrative expenses and overheads. Okay, production overheads will be added to the cost of the PP if the PP is what produced. Okay, so production overhead will be added to the cost of the PP if produced, but general overheads are not. So please be careful. The question 16 I showed you, that lengthy question, it has both administrative um, and general overheads. And we have production overheads. Okay, so production overhead should be added as the PP is being produced or being manufactured. So we have to add it, but the general overheads we don't. Then initial cost incurred, okay, or cost incurred in the initial operating period, such as initial operating losses. The initial operating losses are also not. Watch out. Initial operating losses are not, and also gains too, they are not. If there's a gain, you don't deduct the gain from the cost of the asset. Record it in P&L. And then foreign exchange losses. Maybe you purchase the assets outside the country and then you have to do translations. Okay, per IAS 21. Per IAS 21. Such foreign exchange losses are not capitalized, but we write them to P&L. Right? Then we also have abnormal cost like repairs. Repairs to your PP is not capitalized. If there's a repair, maintenance, those costs, we don't capitalize them, write them off to P&L. Then wastage. Let's say you paid labor 20 million for let's say a year to work on the building. But out of this, let's say labor was not um 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 um, um okay, let me explain this one first. The wastage. So let's say you purchase material worth 200 million for the PPE, and then out of this 200 million, you realize that the material, like maybe because of let's say duration or whatever, let's say 10 million was wasted. Let's say in construction of the building, you purchase cement and stuff, and you realize that 10 million of the cement is damaged or is wasted. You have to eliminate it from the total of 200 million. You take the 10 million from the 200 million because it's wasted. So wasted costs are not included. You buy material and some are wasted. Then you have to get the cost of the wasted material and take it from the total cost of material. Then you capitalize the remaining. Then we have what? Idle time here. Idle time. Idle time. Let's say you paid labor 50 million to work, but you realize that labor did not work for 2 months on the building or on the PPE, and therefore we can attribute, let's say, 20 million of the labor cost to that period. The 2 months that they didn't work, let's say their salary was for what? Um, for 20 million. You have to take the 20 million from the 50 million, and the 30 million that you are going to record because this 20 million is labor paid for duration or period that they didn't work for. So it's idle time. So you'll be saying this. You see a question where they give you labor costs incurred on the PPE or on the building. They incurred 50 million, but you realize that they didn't work for some period, and that period we can attribute 20 million, or we paid wages and salaries of 20 million for that period. You have to take it away. We only want the salary or the wage for the duration that they worked for. So any wages or salary paid for a period that they didn't work for should be deducted. A period that they didn't pay and they didn't work for should be deducted, right? And then maybe here too, this is also very important. It says as a result of testing recently purchased or constructed PPE, product samples might be produced that are sold. All right, and we are saying proceeds from such sales, okay, as well as the associated costs to be recognized in the profit or loss. So we say, okay, as a result of testing recently purchased or constructed PPE, product samples might be produced that are sold. And we are saying that proceeds from such sales as well as associated costs must be recognized in the profit or loss. So sometimes, let's say, you have your building, maybe you are constructing a building and you've got into the first floor. Okay, let's say you are done with the first floor, you've got into the second floor. You realize that the first floor is what ready, and therefore you rented out part of the first floor to somebody and you earn income. We are saying such income should not be capitalized. You don't deduct it from the cost of the PPE, okay? Or you don't need to reduce the cost of the PPE, but rather you record it in P&L. So don't forget, you see a question where They tell you that maybe they are constructing a building as PP and the part was ready, and therefore they rented out that part and they earned an investment income. That investment income shouldn't be part of the cost of the PP. It should be recorded in P&L as an income, and then any associated cost too should be recorded in P and L. Now let's end here. So we looked at the initial measurement of PPE. All right, the cost, what goes into the computation of cost of PPE, what we include and what we don't what include. And I am sure you know examples of PPE. So let's end here by looking at examples of what PPE. So what are examples of PPE? You know your land, you know your what, your building, you know your motor vehicle. Name them. What else? Your fixture and fittings, your furniture, okay, your equipment. All these are examples of what? Property, plant, and what? Equipment. All right. But the main issue is on the use. Okay, land can be not land can be invented to somebody depending on what the entity is into. All right. So these are examples of PPs, land, building, motor vehicle, furniture and fittings, office equipment. You know them, right? So let's end here, and I'll see you. We'll meet again to solve more questions. Don't forget, we still have our questions, so we'll be solving them. But yeah, we'll be solving them in a subsequent meeting. We'll solve all the questions. All right, so let's end here. Now, for your professional exams, you want to be a chartered accountant, you want to be a chartered tax practitioner. If you want to write any professional exams, you can contact us and register with us. CN Professional Institute is an accredited tuition provider. So you want to charter, you want to be a chartered accountant, you can register with us. We also have scholarship packages available. So you can equally contact us and then you can apply and then study with us. Right. So let's end here and then we'll meet again. I'll see you in the next session.